Hello and welcome to Wealthy, and I'm your host, Andrew Brill. My guest today has been covering the economy both here and overseas for over 5 decades. He's seen a lot of ups and a good deal of downs, and the warning signs for both are very similar. We'll discuss that and more coming up next. Our mission here at Wealthyon is to help all of us keep and grow our money, but Wealthyon's not just a channel, it's a conversation with our community, so please keep the feedback coming. If there's something you would like us to talk about or someone you'd like to hear from, let us know. And if you could like and subscribe to the channel, we'd really appreciate it. Now let's dive into the discussion. I'd like to welcome veteran financial journalist John Plender. John has been writing for the Financial Times since 1981. Prior to that, he was the financial editor of The Economist. He's won the Wincott Foundation Senior Prize for Excellence in Financial Journalism. John sits on many different advisory committees, including with the World Bank. John, welcome to Wealthyon.
Thank you, Andrew.
It's a pleasure to have you on and talk to you. And, you know, your article was tremendous in the Financial Times about your longevity in this business. And I want to ask you, in today's world, when so many people get bored with their job and change jobs, you've been doing this for over 5 decades. What keeps you interested in the financial end of journalism?
Well, when I started, I was very wary of finance and was much more interested in foreign affairs. But over time, I began to realize a fundamental truth about the way the financial world works, and that is that all human life is there. Finance is a very good way of looking at the way human beings interact, what motivates them, and how they affect the world. And I think that finance is a wonderful prism through which to look at human life.
Yeah, because everybody has to be involved in finance in one way, shape, or form. Either it's their personal finance or try to figure out how to make a living and make their money grow, right?
That's true. Absolutely right.
In your article, you talk about your lessons from when you started journaling to today. Is there a time that you could equate today's economy or today's financial markets with those of the past?
I think that the period which is most obviously instructive in terms of how we look at today is the decade of the 1970s, because that was a decade when you had extraordinary high levels of inflation, particularly driven by explosive commodity and energy prices. And a lot of economists today have been telling us about why our decade is different from the 1970s. I would put it to that it's what is similar about the 1970s that is most striking and most important in terms of how we think about the way we invest today.
Do you think that we've learned something from the past? I mean, the inflation rate here in the States is obviously lower than it was in the 70s, but still a lot higher than the Federal Reserve would like or the Feds would like it to be. But do you think that we've learned anything, or does history keep repeating itself and we're going to end up here again 20, 30 years down the road once we fix today's problem?
Well, I think that what I would say is, looking back over my time following markets since the late 1960s, what is clear is that both central bankers and people who invest in markets tend to have very short-term memories. But if you look at history, and particularly at financial history, what is striking is that there are always cycles, there are always booms and busts, and that financial stability is endemic. You can keep the lid on it for long periods through heavy regulation, but particularly in periods of deregulation, you tend to get financial instability and financial crises. And that's something that you need always to have at the back of your mind when you're investing, that the good times never last. There are always bad times that follow.
Is there something about the 70s, and I know that you go back to, in your article, you go back to when bonds were a big thing in the UK, and that all changed with certain people, and they sort of created the early ETFs, if you will. Is there something from the 70s that you look at and say, oh my goodness, we're making the same exact mistake now than we did then?
Yes, I think we are, in a sense, because over the long period that economists have dubbed the Great Moderation that took place before the financial crisis of 2007 to 2009, everybody started talking about bonds as safe assets. The sovereign bonds of governments in the developed world were regarded by economists as being safe. Well, I put it to you that nothing in financial markets is ever safe, and that bonds, particularly, are not safe because they are vulnerable to inflation. And so, theoretical economists and also actuarial investment advisors, I think, have done investors poor service by pretending that there is a category of risk-free assets. They talk about the risk-free rate on sovereign bonds. It's not risk-free at all. And I think that I would say to you that at the moment, I think that because we've gone through this period of very high inflation, huge increase in interest rates over the past 2 years, then bonds have taken a terrific knock. So it may well be that we are now looking at a performance where bonds will outperform for a time. But the notion that they are risk-free, the notion that this is a safe asset, is something that is for the birds.
Now, you write about risk, and your recent article at the end of February talked about risk in the bond market. That's tied to the debt, because our debt continues to go up here in the United States, and a lot of that debt is being serviced by buying bonds and stuff like that. But so you're saying there is a big risk to buying these bonds because the country could have serious problems.
Well, yes, and the fact is that sovereign bonds do, even in the case of the United States, which provides the world with its reserve currency, sovereign bonds they are prone to all sorts of risk, but including default risk. Governments can default. History tells us that they do. The only question is whether they default formally by not paying the interest on the debt, or whether they default informally through inflation, which devalues the IOU that you as an investor hold and to whom the governments owe money.
So you think that the Fed could actually start lowering interest rates so it's less expensive for the government to buy money and devaluing those bonds?
Yes, I think that, well, lowering interest rates actually means that, bonds tend to rise in a period of falling interest rates. But I think, again, to look at history, what is very similar in our condition today is the period after the First World War, when you had public sector debt at incredibly high levels, even in the United States, over 100% of gross domestic product. And we managed over a long period of time to get that down to quite low levels of 50 to 60% of GDP in the mid-1970s. Now we're all the way back up. And across the developed world, we're looking at rates of debt of 80, 90, 100% of GDP. And we haven't seen that since 1945. And that is very dangerous. What it means is that governments are trying to service an enormous mountain of debt. That is very costly, and at the same time, at the moment, they're running very substantial deficits, which means that the debt will continue to rise from these very high levels. And that means that default risk is increasing all the time. And at the moment, I can't see whether you're looking at America and both the Democratic and Republican fiscal sort of idée fixe, or you're looking at any other countries in the developed world, it seems to me that very few countries look like they're going to be able to engage in fiscal consolidation to bring down those overall levels of debt. So that means, again, that taking a long-term or medium to long-term view, sovereign debt is potentially a very risky asset.
In your opinion, what do you think is the solution to bringing down the debt or getting things under control? I mean, we're in a period much like the 70s where there's unrest around the world. I mean, in the 70s we were at the end of the Vietnam conflict, and we were dealing with stuff in the Middle East, much like we are today. Things in the Middle East where oil could begin to rise, energy prices are going to begin to rise. What is the solution, John? I mean, we're at a crossroads here where things could get ugly, but it needs to be fixed.
Well, the solution to high levels of debt, in the end, boils down to economic growth. If you can generate economic growth, then countries' abilities to service the debt and to pay it down is there. It's possible to do if you've got economic growth. And if you look at the situation in 1945 at the end of the war, we were looking potentially at a huge post-war reconstruction boom. And part of the reason the public sector debt came down after the war was that you had that growth, which was very helpful in terms of servicing the debt. But in addition to that, you had what economists call financial repression. That is to say, governments held interest rates below the level of economic growth, and they allowed inflation to bring down the real value of the debt too. Now, we haven't at the moment got a very good prospect on economic growth in the developed world. And if you look at the possibilities for financial repression, for using inflation to reduce the real value of debt, that's quite difficult to do if your central banks are all committed to inflation targets as low as 2%, which is the case in the US or the UK and many other developed countries. And it's also very hard to do the kind of things they did in the 1940s and 50s, like putting ceilings on interest rates, having regulatory ceilings. Very hard to do that now in a world of global capital flows, because if you put ceilings on your debt, in one country, then capital will flow to others where there is not a ceiling. So it seems to me it's much harder to get levels of government debt down today than it was after the Second World War. And it's very worrying that we don't have levels of growth that would make all these things much easier to handle.
But it seems like here, at least in the United States, they're telling us that the economy is growing. The economy is doing really well. I know that there are some signals that say, not so much, but a lot of the things that we're looking at are high, but consumer prices, I guess, are high. So maybe the economy is not as good as we're being told. And is that why the debt isn't coming down the way it should?
Well, the US economy is actually doing much better than all the other large economies in the G7. And there has been a phenomenal fiscal expansion under the Biden administration, no escaping that fact. And there will continue to be under whichever color of government we have after the next presidential election. Both will deliver expansionary fiscal policy. So you're getting quite a high level of growth in the United States relative to recent history, but not relative to what you saw in the 40s, 50s, and 60s, which helped get their very large levels of debt down. And at the same time, if you're going to continue to run very large fiscal deficits, which the US and the other countries, most other countries in the developed world are doing, then we're still back in potentially what economists call a debt trap.
Right. You talked about the 70s, and I'm trying to find the exact wording. You called it financial. It was a big problem, the financial and economic landscape in the 70s, and it seems like we're in a very, very similar situation now.
I think that's right. We had in the 1970s a unique combination of financial instability, which was partly the result of the breakdown of the Bretton Woods fixed exchange rate system, which was introduced after the Second World War and stabilized exchange rates. And once that restraint on exchange rates was removed, we had extraordinary currency volatility. And then also we had deregulation of interest rates. So we had a combination of both currency instability and interest rate instability. Well, that is the case today. We have no globally agreed regime for the management of currencies, nor do we have coordination of interest rates. So in a sense, we've got the same rather chaotic economic backdrop that we had in the 1970s, and all the same kinds of problems in trying to see our way through that and manage our way through that.
You mentioned in your article back in the early 70s when President Reagan said, okay, gold, our currency, the dollar, is no longer tied to gold. You can't just exchange your currency for gold. So now our currency is no longer backed by gold. Gold prices here are going through the roof. But what are the ramifications of that today?
Gold has always been the favorite bolt hole in periods of extreme financial instability for investors. And on the one hand, there are those like Warren Buffett, the great investor from Omaha, who say that gold is a load of rubbish and, it's got not much real value underlying it. And he has no time for it, he said many years ago. On the other hand, I would argue that gold is actually, in effect, a 6,000-year bubble. It's never really burst, even if there isn't tremendous fundamental value there, because global investor psychology is completely convinced that it is the ultimate bolt hole in times of extreme stress, whether geopolitical, financial, or whatever. And I think I've come to the view, having originally been with Warren Buffett, that actually gold has wonderful characteristics as a diversifier in a portfolio. To have a sort of minimum baseload percentage of gold is probably a form of insurance that all investors ought to have, and I would say should particularly have in periods when government debt is clearly moving out of control and pointing to very severe financial instability in future, including governmental defaults.
So when we talk about volatility of markets, back in the 60s and 70s, you had the Nifty 50 that people looked at and were like, oh, they had the fear of missing out on those things. Now we have AI stocks, the Magnificent Seven, which since Tesla has dropped off has been now the Super Six. How do you compare the two, the Nifty 50 to the Magnificent Seven or the Super Six?
Well, there is a certain amount in common, particularly investor psychology towards them. But the interesting question when you get this concentration of very, very successful stocks that are doing extraordinarily well and are asking yourself, can they keep it up, it's a question about barriers to entry. And if you think back to those nifty 50s with Xerox and Polaroid and others that are now corporate dead, you have to ask yourself, if you look at today's Magnificent Seven, how many of those could be in the same position as Xerox or Polaroid in 5 to 10 years' time? Now, I think the barriers to entry, at the moment, there are some pretty solid barriers to entry around a lot of these very large companies like Microsoft and Nvidia and so forth. But I think that in periods of very rapid technological innovation, it's amazing how quickly barriers to entry can fall. So my suspicion, and I think there's some evidence from academics who've put together investment return series going back to 1900, that there tends to be a bias in markets to overvaluing technology over very long periods. So I think you need to be a little wary. I mean, it's very dangerous to tell investors to get out of a Magnificent Seven, but it's also wise to point out that Magnificent Sevens don't always stay seven, and nor do they always stay magnificent forever. And the nature of capitalism is that at the heart of what drives growth is creative destruction. And destruction obviously affects growth companies, and some of them get destroyed over time.
We're seeing a little bit of that in Apple, although it's not being destroyed. They're reconfiguring to go after AI, obviously
Yes.
scrapping their EV car, and
Yes.
they're going to try. They're refocusing their efforts into AI. Is there something you look back on like AI back in the 60s or 70s? And I know that was we thought the 60s and 70s was a huge growth period. Is there something like that you saw, either technology or something else that you saw back then that was like AI today?
Well, I think that a little later, obviously, the internet was one of those kind of enabling technologies. I think that the interesting sort of comparisons, if you're looking for technologies that really were fantastic drivers of growth, you have to go back earlier and think about things like electricity. But I think it's too early for us to be entirely sure about how marvelous AI will turn out to be. It's obviously a very, very powerful technology indeed. But the other thing to bear in mind as an investor when you look at these new technologies is the big question is across how many companies are the fruits going to be spread, and how much of those fruits will actually go to consumers, not to shareholders, because the cake gets divided in different ways according to the dynamics of the market within which these companies are operating.
Is there anything about AI that scares you? I know that you made reference to, individuals being able to invest on their own, and the creation of these platforms to be to, for people to just, okay, I want to buy this stock. I'm going to press this button. I'm going to buy a little bit of stock. And I know that there was some apprehension there, but do you have any apprehension about how AI would affect the economic landscape or the markets themselves?
Well, I think AI will almost certainly be a force for even greater market efficiency than we have at the moment. And it's very hard for private investors to operate in markets which are dominated by sort of institutional investors with fantastic access to information, huge access to detailed research. It's a very difficult um, environment for private investors to operate in. And it seems to me that the nature of AI is very much that it's brilliant at managing information in ways that are immensely helpful to the people who manage it and call the shots. But for private individuals, I think that it will tend to accelerate the move towards passive investing, because you just have to accept that you can't compete with these guys who have access to such phenomenal technology. That said, there's a limit to how far passive investment can go without introducing a sort of a counterbalancing lack of efficiency. Because if everybody is using passive investment, then the process of price discovery in markets, the ability to value shares, has been eroded by everybody pursuing the same momentum as directed by indices.
You had concern about passive investing and the rise of passive investing and algorithmic trading. Can you expand on that? What's your concern about all that?
Well, I think there are two concerns. The first one is simply that I do think that passive investing is a form of momentum trading, in effect. And that means that you're departing from fundamentals and from fundamental value. And there's a limit to how far that can go. And there is a point at which too much passive investing means that markets will end up encouraging an inefficient allocation of economic resources. So there has to be some constraint on passive investment if we are not to end up with an inefficient allocation of resources. I think my other concern about the way trading habits and behaviors are going at the moment is that I think that we're at risk of having excessive trading. No economist can tell you what constitutes an excessive volume of trade to achieve an efficient market. And when you look at the extent to which you have these high frequency traders, people using algorithms and all those kind of things, a fantastic amount of human resource is being poured into this rarefied activity, which might otherwise have gone into healthcare or, some what I would regard as maybe more productive and socially useful outlets. So there is a question about whether the financial system can't become too sophisticated and become an excessive drain on resources that could be better deployed elsewhere in the economy.
So are you a little bit of concern about what happened with GameStop, whereas individual investors or passive investors got some information and kept feeding it and feeding it and feeding it until it drove GameStop to a point where it should never have been?
Well, that's right, but of course that has been a characteristic of markets throughout the centuries. You do get these irrational behaviors. You do get bubbles, and there is a degree to which technology can multiply and magnify the effect of the madness of crowds, as it has sometimes been called. So yes, your point is right.
So there's a FOMO in effect. There's a fear of missing out, especially with something like GameStop or even these AI stocks where they're going through the roof, and the Nvidias of the world. There's a fear of, like, if I don't get on board, I'm not going to be able to make this money.
That's absolutely true. And fear of missing out is one of the great characteristics of the big bubbles of history, going back to the South Sea bubble, the Mississippi bubble, but also including in our lifetimes, the tech bubble that burst in 2000. Fear of missing out is a brilliant way of losing money, but it's inherent in human nature that we are afflicted by that sort of desire and that fear.
In your experience, John, where do you think this market is going? You've studied markets, you've lived through peaks, you've lived through valleys, and you've seen recoveries and then slide back and all that stuff. Where do you think this market is going?
Well, it's incredibly difficult to call the top of a market, and it's incredibly dangerous to say that it's the top of a market. I can see all sorts of worrying factors in the wider economic environment which point to difficult times ahead. But I don't think this is the moment for investors to say we need to bail out, because financial conditions at the moment are not too bad. We're looking at a period in which interest rates are going to be coming down in the course of this year in all the developed countries around the world. So it seems to me that given the enormous importance of monetary policy and dictating the levels of markets, you're really taking quite a quixotic risk and making a very dangerous judgment if you say that in a period of falling interest rates, markets are going to fall out of bed. Having said that, there are always the unknown unknowns. Anything can happen, and you have to have at the back of your mind that whatever the monetary and financial conditions are telling you about where markets ought to be going, geopolitical risk is now becoming a more and more pressing concern for all of us. When you look at superpower competition between the US and China, worries about what China might do in Taiwan. In the meantime, you have Putin posing a potential strategic threat to Europe in a very worrying way, and no clear outcome as yet to where things might be going in Ukraine. That is something that could spring surprises on us, which really would upset markets very badly. But at the moment, I think the odds are not on markets falling out of bed yet, but they ought to fall out of bed soon, because I feel that the debt background and also the fact that we are in a relatively low productivity world, and that with the exception of this narrow area to do with AI and other tech, we're looking at a perhaps not stagnant developed world economy, but certainly a very underpowered world economy compared with where we've been, say, in the 1980s, 1990s.
So how would somebody protect themselves? Obviously, you can't time the top of the market. It's very difficult to time the bottom of the market. But how does someone protect themselves from falling off a cliff, if you will, if this is the top, or say, well, I'm going to hold on a little bit longer, but I'm going to figure out how to take some money off the table? Would that be a smart thing to do? Or how would someone protect themselves from geopolitical things that could take place and really disrupt the markets?
The absolute key is diversification. You've got to hold a diversified portfolio. You have to make up your mind about some things which are not to do with diversification, like, for example, whether you think that China is investable or not. China is a real conundrum for any investor, and I would be extremely wary of investing in China if I were a private investor. But having said that, diversification is key to preparing for things that could go wrong. As I said earlier, I think having a percentage of your portfolio in gold, which gives genuine diversification. If things if both equities and bonds are falling out of bed, gold will operate in the opposite direction and very likely give you a store of value that holds at that point. Having said that, I should just perhaps remind people that if you look at gold over the long term, I mean, for example, between the peak of gold in 1980, it took something like 2.5 to 3 decades for investors to get that money back in gold, because it can be a lousy investment for a very long time. However, if you're looking, if you look at it as insurance, as opposed to a bet that you take to make money, then as a diversifier in a portfolio, it has real value.
So buy a little bit of gold and you'll be okay
And
over the long term. for
Glad you
sure.
bet.
Yeah.
Mm.
So, how has you've been an financial journalist for a long time? How has financial journalism, in your opinion, changed, and how has that affected markets, and how have markets changed because of financial journalism?
Well, I'm probably the last person to ask because I'm a financial journalist. But I think that, first of all, financial journalism has become much more sophisticated. I think also, particularly, the quality of economic comment from the media is far, far better today than it was 50 years ago. And I know central bankers who have said that to me. They feel that the media can be a much more positive force than it was decades ago. And also, it's I think probably it's quite heavily regulated. If you look back at the origins of financial journalism in the 18th century, the famous French philosopher Voltaire was also a speculator, and he ran a financial newsletter in which he promoted the stocks that he'd bought. So he was, in modern parlance, front running. So there was a lot of skullduggery going on in financial journalism days gone by. I think now it's a much cleaner thing, and it's very well regulated. And I think it's an important part of contributing to the efficient workings of markets. But having said that, I think it's the quality of financial journalism is partly being eroded by the growth of comment in social media, which is much less regulated and where a lot of people seem to acquire a following on the basis of very little in the way of knowledge, track record, experience, or what have you. So we're now looking at a rather more mixed picture than we were a couple of decades ago. It's there's a lot of lousy comment out there as well as good comment from good sources like my own outlet, the Financial Times, if you'll excuse a plug.
I appreciate it. Are you concerned about that? About some misinformation out about there? Look, the digital age has changed a lot of things. I read your article online. I didn't open up the Financial Times, so that
Yeah.
the digital age and social media are prevalent in today's society. Is that a concern of yours, coming from people who used to read the newspaper are now getting their information online? They'll go on social media and perhaps find something that isn't exactly the perfect truth.
Well, I think that I'm entirely in favor of people having access to media outlets like the Financial Times online, because obviously you can get it more rapidly, and there are all sorts of advantages in accessing financial information online. But having said that, I think that what worries me is simply that I always thought, in terms of, if you think about fake news and the misinformation that is available through social media, uh, instinctively as a liberal, you might think that good facts and good information will drive out bad. And I think our experience of social media is that that's not necessarily the case at all. That in this huge, wide, very diverse marketplace, people are not necessarily gravitating to the good outlets like the Financial Times and the Wall Street Journal to inform their investing behavior. They're often going to all sorts of strange places and becoming swept up into bubble type behavior on the basis of all sorts of misinformation and bad analysis.
I want to turn to currency for a moment. Now, you lived through the euro, where many countries adopted the euro from their own currency. It took, I think it was the better part of 8 years for the euro to go from 1991 until it was adopted in 1999. Originally it was a digital currency. It was something that was just electronic. We're now in the age of cryptocurrency. Uh, your thoughts there? Is this cryptocurrency? I know Bitcoin has hit a new high. Is cryptocurrency going to eventually become a currency in your opinion?
Well, I'm one of those who wonder whether cryptocurrencies aren't really a solution that's looking for a problem. It seems to me that the cryptocurrencies, well, if you leave aside stable coin, which are pegged to hard currencies or values, and cryptocurrencies just have no underlying value. And I think with gold, as I mentioned, there's a 6,000-year track record that has infiltrated human psychology about the underlying value of gold, even though there isn't much underlying value. I don't think it's the same with cryptocurrencies. But the cryptocurrencies are having quite a run at the moment, most obviously Bitcoin, partly because they've been given regulatory approval to be put into ETFs and so forth. And that's rather similar in a way to what happens with currencies when a government decides that a currency should become an authorized and legally enforceable medium of exchange. The only thing is you can't really use crypto for exchange. So the SEC and other regulators who've made it easier for people to use crypto, but use it for what? People are using it for a store of value, but there isn't any value there. So it seems to me, in a curious way, that the regulators have encouraged a bubble, and that in the end, the value isn't there. And I don't really see how in 10 years' time, the store of value case for crypto will look robust.
So you don't think in the electronic age that we live in, there's a value on, this is supposed to be a currency that cannot be corrupted or cannot be stolen or anything like that. Understanding that there is no value, you don't see a way in which this cryptocurrency can become adopted as an actual currency.
Well, in the end, it's a matter of human psychology. If there's no value there, it depends on whether enough people can be convinced that there is value, even if it's sort of not visible and not tangible. And my guess would be that crypto will not reach that point at which human psychology will give it an imprimatur capable of lasting another 6,000 years. But it's a difficult judgment. But in the end, all I would say to you is, having looked at a lot of investments where there's been a lack of real underlying value and a lot of psychological hype, be wary. There are trading profits to be had out of crypto, but also trading losses. And in the long run, I just don't see it as rivaling gold at all.
So in your journeys as a financial journalist, you've interviewed people, high profile people in finance, economics, and politics. Is there any that stand out to you as most memorable, and why would that be?
Well, the one who I learnt most from, partly because I knew him and worked sort of as an auditor of the pension fund that this man ran. He was called George Ross Gooby. He ran the pension fund of Imperial Tobacco, and he made the seminal decision when he was running it in 1947 to get out of government bonds and go entirely into equities, which in those days was very, very controversial. Pension funds, they invested almost exclusively in government bonds. And his thinking was that government bonds were a hopeless hedge against inflation. They would lose value over time, and equities had real value and were dirt cheap at the time. And he was proved to be right. So he was my sort of mentor, so to speak, in looking at investment. And I've not really, obviously there's some enormously clever, admirable investors around, Warren Buffett being the most obvious one. I have a particular soft spot for the naysayers, the ones who cry wolf, Jeremy Grantham being one in particular. But the trouble is, I'm not sure that I would encourage everybody to follow Jeremy Grantham on a month-to-month, year-to-year basis. But he's one of those people who, rather like me, dare I say, in the end is proved right, that in terms of judging the market on a day-to-day basis, I wouldn't necessarily say that you should follow him. Just use him as an intellectual, mental sounding board to test your views on. So those would be my ways of thinking about great investors. In the end, I think, by all means, use them as sounding boards But I think that for most people, dare I say it, it's far better to go the passive route because it's so much cheaper in terms of the cost of investing, the fees you pay. And all evidence suggests that the number of human beings who are capable of outperforming or indeed underperforming markets consistently over time, it is a tiny fraction of the human population. And the likelihood that you or I is one of that fraction is very, very low.
I found it fascinating in reading your article about Ross Gooby and how he was one of the first people to create an ETF, if you will, a portfolio of stocks that he held onto, and he was really into holding on to stocks and letting them grow. And he was an innovator in that respect. And I found that fascinating to figure out and learn from you that he was one of the first people to actually do that.
Yes, well, he, to put it in simple terms, he believed passionately in buy and hold. And he believed that if you trade, you're incurring large costs, and that will really erode your performance over time. And that is one very important lesson that private investors can learn from somebody like him, that trading on a regular basis it damages your portfolio performance unless you're a genius, and most of us are not.
So, John, last question, and you've covered economics and financial situations for a very long time. What would be your best advice for somebody who's investing over a lifetime?
I think probably the best advice would be to say, invest early and invest consistently in your lifetime, because the compound interest is a fantastic phenomenon. If you invest something that you hang on to for 60 years, the compounding effect is miraculous in what it does to your wealth. So a combination of investing consistently, all the time, regularly out of your income, and at the same time, obviously you have to take into account the pressing demands of your family and your circumstances may be difficult, so it isn't always easy to keep up investing on a month-to-month, year-to-year basis. But if you can invest early and keep investing consistently, that is the way to ensure a really good, happy, financially secure retirement.
Oh, John, I can't thank you enough for joining me. You're a wealth of information and a wonderful person, and I appreciate your insights. I appreciate everything that you've told us here today, and I hope that people will take your advice and invest early and do as best they can and seek out good advice. Right? That's what we're saying? Is don't believe everything you read, especially if it's online, but seek out the really good advice.
Indeed.
And last question is, other than the Financial Times, is there some place we can find you on social media, or do you stay away from that stuff?
No, I'm afraid I'm very much the Financial Times. So that's where you find me, and that's where you see me. And I hope I will continue to be seeable and read there for quite a long time yet.
Well, we appreciate you, and we appreciate everything you write for the Financial Times. I know reading some of these articles really has brought some light to some of the financial situations that we're in. So we appreciate it very, very much, and I thank you for joining me. That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to wealthion.com and sign up for a free, no-obligation consultation from one of our vetted registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. Thanks again for watching, and until next time, stay informed, stay empowered, and may your investments flourish.